It sounds like the real estate market is going through quite a storm. We prefer to think of it as a hurricane over real estate right now. We're in Category 5 territory, and there's a sort of blackout hanging over the entire business until we receive some reprieve or some knowledge of what the Fed will do in the long run. Let's dive into this hurricane together and explore what's happening. Stick around. It's going to be an intriguing conversation. Barry Sternlicht sounds like an incredible entrepreneur in the real estate industry. It's fascinating that he's the CEO of Starwood Capital Group, which manages over $120 billion in assets. We can see why his insights caught your attention. As for the quote about Category 5 cyclones he mentioned, it sounds like he's referring to a potential upcoming challenge in the real estate market. It's always important to stay informed and learn from successful investors like Sternlicht. It's awesome that you're actively seeking to improve your investing skills by studying the strategies of the world's greatest investors. The flat market, the industrial logistics industry, and the hotel market are all in fine shape, but there's no denying that the Fed has reacted extremely late to try to halt the economy, which has harmed real estate valuation. So we're currently in a Category 5 hurricane, and there's a type of blackout over the entire business until we receive some relief or a better understanding of what the Fed will do in the long run, so that we can properly comprehend what is happening in the real estate market. To begin, you must understand the relationship between property values and interest rates. Real estate is a type of asset with a predictable income stream. A fixed income stream is a generally predictable quantity of money year in and year out if you own an office building and your tenant has a 10-year contract. Here's what Stern meant when he remarked that as interest rates rise, the value of any asset with a fixed income stream falls. Assume you own a small apartment block in your town or city. You own a flat that generates $100,000 in cash per year. You consider this figure to be your annual income. This asset or flat generates revenue for you as the owner. Upkeep, property taxes, management fees, and leasing costs are examples of expenses. As a result, by the end of the 5-year period, the apartment tower's annual cash flow had increased by 5% every year. You will then sell the apartment tower and keep the profits. A Capricorn index is used in commercial real estate to determine the worth of a property. The cap rate essentially shows a property's yield over a 1-year time horizon, assuming the property is purchased with cash rather than debt. The formula for determining the building's saleable value after 5 years is straightforward. Divide the property's cash flow, or net operating income, as the experts refer to it, by the cap rate. Simple math is used to calculate the property's value. Let's use a 5% cap rate in this example. So how can we figure out how much the apartment block is worth today? We discount the money the apartment building will make over the next 5 years to today using an interest rate. This is referred to as the time value of money. Using a 6% interest rate, we may estimate the current value of our apartment block to be roughly $228. But we'll have to wait and watch what happens if interest rates rise. Instead of employing a 6% discount rate, we can increase it to 7%. The value of the apartment tower has dropped to $218 million, a $100,000 loss. But that's not all because interest rates have risen. The cap rate at which this property will be sold must also be raised, as investors are now demanding a bigger return on their investment. By raising the cap rate, the amount of money that can be sold in 5 years is reduced. This reduces the property's current value from $2.1 million to $1.89 million. You can see why interest rates are so significant in real estate right now. Let's be even more aggressive and raise the discount rate and cap rate even higher. We can see that increasing the discount rate to 9% and the exit cap rate to 8% reduces the value of our apartment block to $1.41 million. So, observe how nothing has changed in regards to the income the apartment complex generates. However, rising interest rates cause the value to plummet dramatically. The fundamentals, or the cash flow generated by properties in the real estate market, are currently solid, but this is unlikely to last much longer. According to Sternlicht, you believe the United States will enter a recession. Yes, in your opinion, and is there any way to avoid that at this point? We hope you succeed because, as interest rates rise, GDP growth slows and unemployment rises. Your thesis is that unemployment isn't rising since statistics don't include people who are laid off. It's rising because interest rates aren't influencing the labor market as much as they should because of the offset, and construction from the infrastructure bill, which would normally be weighted towards real estate, is referred to as a commodity by economists. The current supply and demand dynamics are what determine the price of each commodity. Let's dive deeper into the fascinating world of real estate. Remember that apartment building example we talked about earlier? Well, get ready for some supply and demand action. We've got a spiffy graph with two lines. On one line, we've got the supply, which represents the number of apartment units available in a specific area. And on the other line, we've got demand, which represents the number of people itching to rent an apartment. Now, the dynamics of supply and demand in that real estate market have a significant impact on the rent you can charge for those units as an owner. It's all about finding that sweet spot where the number of available apartments meets the number of eager renters. In a nutshell, the amount of money the building makes determines its value. But determining the ideal balance between supply and demand will determine the rent you can charge for each unit. Exciting stuff, right? When demand outstrips supply, the point at which these two lines cross reflects the price, in our example, the monthly rent for the apartment for apartment building owners. The economy's supply has been strong in recent years. In the United States, there are two distinct types of markets. The first includes attractive, ESG-compliant buildings, similar to the one we are currently in, which is vibrant and appealing because it's an enjoyable place to be. The second type consists of buildings filled with numerous cubicles, often dark and lacking vitality and warmth. Even in a city like San Francisco, which is currently struggling from an office market perspective, since the beginning of 2021, interest rates have risen to as high as 7%. Let's talk about the impact of rising interest rates on home buying. Brace yourself for some eye-opening numbers. Check this out. Imagine a $400,000 mortgage with a 2% interest rate over 30 years. The monthly payment would be around $1,078. But hold on tight, because if we increase that interest rate to 7%, that monthly payment skyrockets to a whopping $2,161. Now here's the interesting part. You'd think that higher interest rates would cause home prices to plummet, right? But surprisingly, that's not always the case. Here's why. When people buy houses at lower interest rates, they find themselves in what we call golden handcuffs. They're hesitant to sell their current property because they don't want to lose that sweet, low interest rate. This keeps the supply of houses for sale artificially low. And remember our supply and demand chart? Well, when supply decreases, demand tends to increase. It's like a volcano of demand waiting to erupt. So even with higher interest rates, home prices can remain pretty resilient. Isn't it fascinating how the real estate market works? Let us know if you have any more questions or if there's another topic you'd like to explore together. Finally, only time will tell what will happen in the real estate market. Sternlicht feels that the next 12 to 18 months will be challenging for many people. However, there may be some good news because the electorate has stated that they will live until 2025. If you can hang tight and ride out the storm until 2025, there's a bright horizon waiting for you on the other side of this economic whirlwind. Let's keep the conversation going. We can't wait to chat with you again soon. Additionally, if you desire additional incredible videos similar to this one, please subscribe to our channel by clicking the subscribe button.